Hey everybody, hey traders, Chris Pulver here. Doing a little video update based on whatever you want to call Monday, August 5th. Some interesting statistics that I was sharing with the traders today. A couple of things. This is what the heat map looked like from Monday's close. I think you could say it's a pretty nasty day. It was really the volatility expansion that caught the market off guard, and a lot of it was a bit of a carryover from the massive drop we saw on the Nikkei 225 and a big push in the yen and the Swiss. So we had some major risk off flows. We have an incredible amount of volatility in the forex market, and we had a 12+% sell off in the Nikkei. And here was an actual interesting factoid here. So when the Nikkei is down heavy for 2 trading days. In fact, over 17% last 2 trading days. That would have been Friday to Monday. That's the the largest 2-day decline in history. But what's interesting is 3 other times previously since 1987, following that type of decline, it's actually been positive over the next 12 months. So I do think for the longer term investors, this will be seen as a buying opportunity. For the near term investors, it feels like buckle up for more volatility. I am watching the VIX very closely this week. I'm watching the Nikkei 225 very closely this week. I'm also watching the currency strength chart day to day. This is the current currency strength chart going into Wednesday's trading over in Asia. So we have a bit of a weakness move right in the Swiss and the yen to kick things off, but obviously things will unfold, and we have seen much higher volatility. I mean, Monday we saw, I think I have a screenshot of this in one of my channels here, so just give me a moment, I'll show that. I shared basically an August 2nd and an August 5th, or an August 5th and August 6th currency strength reading. So I'll show that right here. There we go. So August 5th would be Monday. That's your big, ridiculous volatility expansion and almost a crash with the carry trade unraveling very quickly in the Japanese yen. The volatility that I read here, some currencies actually moved over 500 pips in a single day from Sunday to Monday. Well, it depends on where you're at. It's basically Monday's trading. But Monday we had huge, huge moves. It was all Japanese yen and all Swiss franc as far as strength. The Swiss actually came into some really key levels as well. So I want to talk about that here in the charts. Let's just have a look at everything. So the S&P, the Nikkei came ripping back here for Tuesday's trading, and that certainly helped kind of calm things on the SPY and the Qs. But I'm not necessarily loving that type of candle behavior. We did kind of fade late in the day. Here's another way to take a look at it. Here's the NDX. Watching this all day. I took a little income trade right there, 18,430 by 18,440 for a bear call spread. Generated about $1 credit for a little intraday scalp. And here we are, potentially breaking a trend line. So I'll be watching this pretty closely tomorrow to see if there's more downside. I do have some hedges that I put on. That was really what Monday allowed me to do. Was Sunday was futures. Monday the markets were opening. Opening bell was pretty brutal. The bid ask prices are very wide right now, and still wide as volatility remains elevated. But I am curious if this is a nice little gap fill and a test and an attempt. However, maybe we are going to retest the lows, and I don't know if that comes with another nasty down day or another big gap to the downside. Kind of the one nice thing that we have this week is we don't have a ton of fundamental news. So if we looked at an economic calendar for this particular week, if I go to this week here, we don't have a lot of news to digest. So we're going into Wednesday's trading. We had some positive news out of the Kiwi on let's see, the 6:45 p.m. Eastern time. So we had a better than expected unemployment rate and a employment change that was positive from a negative expected forecast print, negative 0.2 to 0.4. So Wednesday morning, we have really nothing major for the U.S. outside of the 10-year bond auction, the 30-year bond auction. Things I'm watching as well with the inverted yield curve. Are we going to see the 10 and the 2 go back to normal and get out of the inversion? Are we going to see the 3-month and the 10-year get out of the inversion? Yes, no, maybe so. Possibly watching the 3-month and the 30-year as well. Historically, there's some pretty interesting times when that happens. So anyway, not a bunch of major news, which is kind of a good thing considering what we digested last week with Bank of Japan rate decision, plus the Fed, plus the Bank of England. The Fed, basically the market treated the Fed like you guys messed up and you should have cut rates. Well, now the market's begging for an emergency rate cut. I just don't think it's going to work that way. I mean, I will give Jerome Powell credit for just being very consistent and about as transparent as you can be for the Fed, which is designed to really not give anybody any information. The market's anticipating a high probability rate cut in September. We've waited long enough. Employment data has ticked higher. The SOMRU was triggered last week with the 3 month. Basically, it's the 3 month unemployment rate, and it's been rising over the previous low of the last 12 months. And so once we got above a half percentage or a half percent higher, that's what triggered the SOMRU when we printed that unemployment rate on Friday for non-farm. So a lot of things were kind of snowballing into this this potential volatility stretch, and we got it. And if you just look at the markets from Thursday, Friday to Monday, just a crazy, crazy move. Um, and I mean, if you want to compare this to 2022 was a nasty correction, the markets pulled back 20 to 25 to 30%. Well, it didn't happen in one day. I mean, it was over the course of 6 months of corrections, and the volatility never changed from around 15 to 30. Maybe 30 to 35 was the high, but we didn't have a spike up towards 65 like we had in the VIX this week, which was Monday's print, which was, again, very, very crazy. And so maybe we're going to label Monday, August 5th as Volmageddon 2.0 or Black Monday, 2024, or call it the vol, whatever. You can call it whatever you want. Point is, if you're a trader, this is on your radar now as something to make sure that if you got stuck on the wrong side of this move, you know how to trade through it or potentially prepare for it. But it is a bit of an outlier. I really think it's more of an outlier. That doesn't mean that this is a huge buying opportunity. What I'm essentially looking for is volatility to contract and start to head lower. I'm looking at the term structure very carefully. We're looking at 27.7 on the VIX right now, and just over the next several months here, let's see if we get back into the 20s, settle back in. If we're sub 20, that's okay. The average, the average for the VIX historically is around 17 or 18. So if we get sub 20, that's a little bit more in line. But we're probably not going back towards 13 or 12 anytime soon. I would imagine that now that we're sub 30, we might be oscillating between this 20 to 30 zone if we're going to continue to have some pressure to the downside. How do we watch this? How do we watch for the triggers? Well, just look at price action. That'd be the best thing. So taking a look at the one of the 4-hour time frame here. I don't like how today closed necessarily, especially this aggressive fade off the gap. So coming into this perfect level of past support and starting to drop off of that, I don't love that. So going into tomorrow, I'll obviously be watching pre-market. If we're opening up pre-market lower, then I think that this may be a short-term top. We open pre-market. If we're lucky enough to get a gap fill and then maybe look to see if we have a nasty day to the downside, we might have one more flush to the to really see where those bulls are at or really see how strong those bears are. So I will be watching this very carefully. I'm also hedged this week on the SPY, and probably for the next 30 to 45 to 60 days, I'm going to continue to be willing to pay for some of my hedges. So, putting out 0.25% or 0.2% of my account and putting on some decent hedges that might pay 5 to 10 to 1 and going out maybe 1 or 2 weeks out. I know that's pretty tight, but that does keep the risk really small. And if we have another kind of flush and another outlier event, I'd like those to get paid pretty well. And one of the tricks I've learned over the years as hedging, especially when it comes to stocks and options in the futures market, is if you are out of the money and you have more contracts, that tends to actually help your hedges a lot more than being at the money and having higher deltas and more expensive contracts. So anyway, I'm doing that essentially on the SPY right now for this week. I have a trade. It's not. It must be on this chart here, perhaps. Let me see the SPY. Yep. So I have the 510 by 499, which is back here near the lows. Now 510 is the low. So what I really need to see if I'm going to have this hedge play out, and truthfully, I don't really want the hedge to play out, but in the event that it does, it's something that allows me to make some profit and kind of mitigate and wash some drawdowns that I'll be experiencing with some of the exposure that I have. But in the event that it costs me about $1.80, I can make up to $10, $11 net profit if we push all the way down towards 500 or 499. We'll see how quickly we get there, but that would be at this point a pretty massive flush from a Wednesday to Friday, since I have the expiration out to this week. If we push down to 500, that'd be another 4% decline from today's close. I'm not saying that it's not possible, but I'm thinking it's probably low probability. But I have it on the SPY. I have it on the Qs, and the Q is a 423 by 410. Again, back down the lows, we'd have to have another pretty decent sized crash to that one, and we'd have to drop all the way towards 410. That would be another roughly about 6.6% move or so. Is it possible? Sure, maybe. We probably have to have some massive gaps and some disappointing earnings to have that be the case, since the news is a little bit quiet this week. I would imagine that if we just flush back down to the lows, if they were to happen tomorrow, there's a chance that this could pay out a little bit, or at least maintain some of the extrinsic value. But again, I'll be watching it very carefully and see what happens, because when I took the trade, we were sitting here, and so if we do have a decent push to the downside, for a $1.70, this might be trading for $5 or $6. The IV is still pretty high in the markets and the indexes right now. So that's what I'm watching for some short-term hedging. Out for the medium term, I'm still looking to see. Let me switch charts here. I'm switching over to the FXY, which is an instrument that I've been watching on the yen, and I've been long on this instrument, as opposed to getting into the yen pairs. All I've been doing on yen pairs is buy one, sell one, and have the winner, and it's been on the sell side, obviously. The winner has just been bigger. So if I were to do, let's say, the euro yen versus the pound yen, I would buy the euro yen, sell the pound yen, go after a 250 pip profit and a 125 stop loss. I get triggered on the stop loss. I let the profit run to double the size. I net some profit. It's a bit of a pairs trade. I did that on the Aussie yen versus the Kiwi yen. I did that on the euro yen versus the pound yen. That's worked pretty well for me over the last couple of weeks, as this yen trade has accelerated and unfolded very quickly. But at this point, with that type of move and that event that we had on Monday, I'm really kind of out of that trade for right now. I'm not interested in buying dips on yen pairs. I'm not interested in fading the yen pairs right now. I'm just looking to see where things kind of stabilize and just chill out for a second. But I'm also using Monday and Tuesday as a prep to potentially, hedge up a little bit just in case, and then let some of my current positions just play out as is. We've had some pretty healthy corrections, as I said. If we go to the FXI has been performing well. I own this at $60. We're up to 64. I do have some out of the money call options here, out of the money out to 2025 and also out to 2026. I'm going to see if this yen thing continues to rip. If that is the case, it's going to put a lot of pressure on the Nikkei 225, but a lot of pressure on the global markets as well, as we've seen. And the carry trade did act faster. Traditionally, in my career, I've seen the carry trade last, about 2 years, and we started to see this trigger in March of 2022. And here we are well, I guess I got that right. Just over 2 years. So I guess the joke's on me. We stretched over 2 years from that March 2022 move. For some reason, I think it was the inverted yield curve. I was thinking October, thinking like seasonality. There's no way this carry trade unravels in, summer of 2024. But at the same time, now to think about it, it's perfect for a low volume, just volatility expansion, and that's exactly what we had. So fudge. I guess I got it all wrong, huh? Well, here we are talking about it. So the nice thing is, I was looking for some Japanese yen long starting in June and July. I did get a nice move on this. I'm still long in the FXY for right now, out to January 2025 and into 2026 with some option trades. I was able to load up at this $70 for maybe 85 cents debit, and I loaded up enough that if that expands, that should be a nice little profit. Hopefully, I can turn maybe about an 85 cent debit into maybe $9 or $10 worth of profit, which would be a pretty good trade. So that is that. I'm sure there's some traders out there watching Bitcoin, maybe even got a taste of that below 50K and bought into it. We're up off those lows. I'm looking at Bitcoin potentially as a channel for right now. Okay, but I'm not just buying this. I did not buy it because I already bought it over here. When we had this equal low around 56 or 55 grand, that's where I took another stab at Bitcoin. I have some exposure on Bitcoin itself. I have some exposure through IBIT and BITO. Those are the approved ETFs, or at least one of them is. IBIT is a BlackRock and BITO is ProShares. So I had some exposure there. Gold. I see a lot of traders asking me about gold every single day. And what is it about gold? I think it's a great medium to long-term trade. It's always been a staple in most professionals' portfolios. I personally have about a 3% exposure in gold and another 3 to 4% in silver. I actually like silver better on the technical side. To me, silver is, number one, it's cheaper. I can have more shares at this price, but they don't necessarily behave the same way. Gold has been maintaining its value a little bit better than silver recently, but to me, this is still a really good spot to be looking to buy. I was looking at this as potentially comes down, finds a support level, maybe a bear trap, and then pop back up here. I'd like to get long again at the equal lows, possibly put in some futures trades, maybe some option trades, as well as buying some more shares of GLD. And then for silver, I already own shares of SLV. I'm also long silver futures, and I'm looking for this potential bounce right around this $26 handle for potential support as we had a resistance breakout here. So silver would be nice. Yeah, I would consider adding to my long positions if we work our way back up to these highs and then consolidate. I'd be looking to buy this pretty aggressively to the upside with confirmation, maybe getting some call options up there and trading futures as well. So that's some silver and gold action. We talked about Bitcoin, oil, a little bit more resilient at equal lows. Let's see what happens here. It could certainly fade with slowing demand, but things pick up a little bit. Maybe OPEC jawbones with some production cuts, perhaps. But the U.S. is producing at a pretty high level right now for natural gas and oil. So just based on slowing demand and excess supply, we are seeing oil prices drop. I just have some credit spreads on oil futures, nothing crazy, nothing major. But I would be interested in looking at some support down here at the same, 67 to $65 zone, and probably get long on oil in the medium term. Dollar index is something really important to watch for me. Two things. This is either a diamond pattern where we have indecision, where we're making lower highs and we're making higher lows. And this will continue to be a very challenging basket to trade. If the market can't make up its mind, the dollar might be a basket that I don't really love trading at all. Okay. Now, if this is the case, this would have to play out probably for the next 2 to 3 months. If we can't make a clean break lower, okay, if we can't make a clean break lower, then I'm just going to stay out of the dollar for the most part. And each individual currency pair, I will just continue to assess. But if we have a pullback to 104 in the short term, I might be looking for an opportunity to keep a tight stop and short the dollar and see if we can get back down to 100, or actually 101 first and then 100 second, and see if there is a short opportunity on the dollar for a decent and asymmetric reward to risk, where I can keep the stop loss pretty tight if we see a 104 rejection. But the opposite side of that, this is where I'd be concerned. If the dollar comes back in here and actually starts getting in strength and shows us some bullishness, that to me would be a bit of a nail in the coffin for the stock market. Okay, I do think this year, for the rest of the year, look, we're gonna have to digest Jackson Hole at the end of August. We're gonna have to dissect whatever, or digest whatever the market's gonna react to with the Fed rate cut cycle, whether it's 25 basis points or 50 basis points, or anything else for that matter for the rest of the year. Maybe 3 cuts in 4 months. All right. But I do think that in order for the stock market to stay resilient and possibly bullish through the remainder of the year and get back towards the all-time highs, maybe eclipse them, but try to make at least an effort to get back to them, I personally think that the dollar has to go down. If the dollar doesn't go down, I think it's going to be a very tough market to see higher highs, in my opinion. So to me, I think the dollar is timed well enough where if we start to see a weaker dollar, that provides some resiliency to the overall equities market. That could also be a good runner for Bitcoin. That could also be a good runner for gold. That could be a great runner for a lot of things. Global financial markets could benefit from a weaker dollar. Um, Not saying it's going to happen. I don't know. I will be watching price action closely. But for me right now, since we're below 104, I remain short-term bearish on the dollar and looking to see if this will accelerate a little bit lower. 101 is target one, 100 is target two, and then I'd be trailing stop losses any lower than that. And then if it just stays indecisive, if I get a move back and I take a trade here with confirmation and it blows me up through 104, then I am not going to be that interested in trying to short the dollar. And then I just wait for more confirmation, try to get out of this wedge and see what the heck this thing wants to do. So to me, the fun on the yen is kind of over with. As long as the Nikkei doesn't lose itself into another massive sell opportunity or another drop, I'd like to see if the yen can stay a little bit weaker. But I'm watching the dollar very closely because I think the next big basket trade is going to be coming from the dollar. I do think this higher volatility that we're getting in the stock market will also trickle its way into the currency market. For better for worse, we could see risk off trading, which is stronger yen, stronger Swiss, stronger dollar with higher volatility, or we can see risk on trading. And I think a lot of that would be the weaker dollar that would hopefully translate into a nice dollar basket trade, and other currency pairs reflect that. And maybe some risk appetite, giving the Aussie some strength, the New Zealand some strength, and maybe even the pound. So index wise, watching closely. Futures wise, watching closely. This is probably going to be one of those more, I wouldn't say sleepless weeks, but certainly one that I'm paying close attention and kind of monitoring things around the clock, setting lots of chart alarms out there. So that is it. I hope this helps. Happy trading, lots of profits. I hope everyone's doing well out there. Monday was a bit of a wild day, and I just want to make sure everyone's doing okay. I'm here to help if you need me. But interesting factoids for the long-term investor. This is just a pullback. They happen, right? Every there's a couple times a year we're going to get a 5% pullback. Once a year we get a 10% pullback. Once every couple of years we're going to get a 15%, 20% pullback. this does happen. Pullbacks are okay, but it's crazy how the market reacts to it, and it seems like the world has to end and the sky has to fall in order for us to see, a 5 or 10% correction. So off the recent highs, okay, just before I wrap things up here, off the recent highs, we have seen a correction to the tune of about 9.6% on the S&P, and on the NASDAQ, a little bit deeper than that. We end up getting down to around 15.8%. So I would say that's pretty healthy as far as a correction goes. In order to, kind of bottom out, and I think bottom out in a healthy fashion, we shouldn't necessarily just go high, low, lower high, lower low, and then V bottom, and then off we go. I don't really want to see a V bottom. I certainly don't want to see emergency cuts out of the Fed either. I've been talking about that all week since I was doing live sessions. I don't want to see a V bottom. What I'd like to see is we go high, low, lower high, lower low. I want to see the market bounce up like it did. Okay. If we start to stabilize here with a little bit of pullback, that's fine. And we'll see if we bounce from there, or really it's just a test of the level or a failed level. And I could see this too. This trend line goes back to the lows in 2020. There's another chance to bounce right off of that. Okay. So is there a case where this is a little recovery for Monday, Tuesday? We come back down to retest that level, poke those levels, bear trap, and then rip back up here for a little bit more of a recovery. I don't think all-time highs are going to be achievable at this time without a lot more price confirmation. I'm way more skeptical of this move, at least in the near term. Over the next probably 4 to 6 months, all-time highs might be difficult to reach. But I would rather see the market here in the next 6 months than here in the next 6 months. I mean, and I think most people would. If you're a long-term investor, you'd rather see the market, hanging out near all-time highs, trying to justify going higher with a continued expansion. Even if we're in like the 7th or 8th inning of this expansion, we'd all rather see the market wanting to go up or trying to go up and having justifiable reasons to go up, as opposed to dumping and dumping and dumping. And oh my gosh, now we're talking about 20% and 25%, 30%. How much worse does it get? Nobody has a good time if that's the case. And with this type of event, although it seems like an outlier, if we were to get another round of that in the next 10 days or 30 days, it is going to trigger some pretty nasty stuff out there, because that vol expansion can be very, very dangerous. All of the leverage is closing up. And if those out there, even some of the biggest funds in the world, if they can't survive, fund one gets transferred to fund two, gets transferred to fund three, and it could be really, 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 really ugly. So point is, we have to watch this stuff closely. That's my job, and we'll see what happens. So, all right, I'll let you go from there. Happy Tuesday, and talk to you all very soon. Bye-bye.